So you're familiar with the 60-40 rule. This is a rule that states that you invest 60% of your portfolio in stocks or equities and 40% in bonds. Now, last year, about October, November last year, Bank of America released the report stating that the 60-40 rule was dead. Well, that's what they said. And that was because as of last year, due to the fact that interest rates was drastically increased, the portfolios that had a 60-40 rule distribution in them lost a lot of money. And it was actually in comparison to 2008 market crash. That the equivalent of losses incurred was almost as those, in terms of percentages, was also experienced last year by those guys that had a 60-40 distributions in their portfolio. So the question begs, is this 60-40 rule still something to use? If you're new here, my name is Stephen Ojo, and on this channel we talk about finance and investing. So if you're interested in that, do not forget to subscribe. By the way, this is not financial advice. This is just for entertainment purposes, all right? As we know, the stock market has been dropping lately, especially today. Right now, it's down almost 600 points. The S&P, the Dow is down almost 600. The S&P is down almost 1.8, almost 2%. Of course, that is not good, and we all know why that is going on. This is all due to the fact that there's a lot of fear, and fear that interest rates will go up, of course. So the market is selling off. Now, should we be worried? Generally, we are told that if we had the 60-40 portfolio mix, well, we should be able to weather the storm. And this is generally touted towards the people that are planning to retire. And in fact, once you get into retirement, that number flips around. So you should have about 60% in bonds and then 40% in stocks in retirement. And as you get older, you kind of always try to shift towards the safer investment. Now, the reason behind this is just to reduce your portfolio risk. But let's talk about bonds for a second. We all know that we have different classes of bonds and different types as well. But bonds are pretty much loans in which you are paid a coupon over time. Now, the issue is that when these bonds are made, they are made with certain rates. Interest rate, by the way. So you buy these bonds thinking you're going to get, let's say, 3% or 4%. But guess what? When interest rates goes up, it makes the value of the bond goes down, which means your 4% now in real world is no longer keeping up with inflation or the current interest rate. So as we know, interest rates has been going up due to the CPI report and is likely to cause the Fed to increase rates again further in their next meeting coming up in March 21st and 22nd. The speculation is that the Feds will probably increase by 50 basis points. And this is already being built into the stock market right now. So back to bonds. Because of the increased rate throughout the course of the year, last year, which is likely to continue into this year, the bonds became less valuable, which meant that they lost value. And also, this affected the equities, the stocks as well, which is why the stocks also took a downturn. So the question is, are we still recommending the 60-40? Like, is this still a recommendation for people? It all depends. Because if you look into this year, all right, as of last week, it was released that the 60-40 rule is now up by almost 6.8%. So that means if you had 60% of your investment in stocks and 40% in bonds, you are up about 6.8% so far this year. Of course, this year is so early, we're not even done with the first quarter. So do we think this is going to hold through for the rest of the year? In my opinion, I don't think so, because we are still thinking of this recession that we are likely going to hit. I mean, they're talking about soft landing, hard landing, maybe no landing, but all of that begs the question, should we be thinking of keeping our money in a 60-40 rule? Now, one thing I want to put to you is this. Warren Buffett, as we know, has mentioned that when he passes, he wants his portfolio to be distributed at a distribution rate of 90 and 10, which means 90% in stocks and 10% in cash. A lot of other, wealthy billionaires prefer to hold more on the stocks than the bonds. And the reason is because bonds can be very low, can offer very low returns, even though they are supposed to offset your risk. But of course, less risk means less reward. And also in this environment we're in, the fact that interest rates are so high means that a lot of bonds will be less valuable. So the question is, depending on where you are in the phase of your life, all right, whether you're just starting out or whether you're planning to retire soon, you need to look closely at your portfolio and see where you're distributed heavily. So stocks right now are going down, and as we know, they present opportunities. It is up to you to choose to buy more of those stocks that you believe will do well long term. And if you're not willing to buy individual stocks, then why don't you just consider index funds? On the other hand, bonds so far have had negative returns, and they will probably continue to do so even through this year because of the fact that interest rates will continue to go up until inflation can come down to almost 2%. Then maybe bonds can then resume a normal trend. Personally, I would avoid investing in bonds just because of the current environment we are in. Now, instead of bonds, the alternative would be cash. Now, we have to keep in mind inflation is high, but the reason why we are holding or thinking of holding more cash is to be able to invest in the stock market when it bottoms out, or at least as it bottoms out, which means you're able to dollar cost average, and hopefully you can ride the recovery when things turn around. Now, all of this all depends on your time horizon, your risk tolerance, and how much you're willing to bear in terms of volatility in the market. Because today the stock market is going to be up, tomorrow is going to be down. We know that for a fact. But as we know, long term, the stock market is always the best because it returns the most.